The worst possible thing you could do right now with $5 million is buy a luxury second home in New York City. I know that sounds insane. New York is New York. It's the greatest city in the world. But here's what's actually happening right now. And once you see it, you cannot unsee it. New York City Mayor Zohran Mamdani recently filmed himself standing outside billionaire Ken Griffin's $238 million penthouse at 220 Central Park South. And he looked directly into the camera and said,
"When I ran for mayor, I said I was going to tax the rich. Well, today, we're taxing the rich."
The video was viewed over 52 million times on X. Ken Griffin had to watch it twice. He called it creepy. He said it put him in harm's way. And then he announced that his $60 billion hedge fund, Citadel, is doubling down on Miami and scrapping a planned $6 billion Park Avenue development. That one video may have just cost New York City billions of dollars in economic activity. And today I'm going to show you exactly why that matters for anyone who owns, is thinking about buying, or is investing in luxury real estate in either of these two cities. Because the economic conclusion here is not subtle. It is loud, it is clear, and most people are not paying attention to it yet. So in this video, we're going to break down the great wealth migration, what I call the capital relocation effect. And we're going to look at it through three lenses. First, we're going to look at the political risk in New York City, specifically the pied-a-terre tax and what it signals about where New York's government is headed. Second, we're going to look at the raw market data, price per square foot, appreciation rates, tax savings, and where the smart money is actually flowing. And third, I'm going to give you the honest conclusion, not the politically comfortable one, the accurate one, about which city has the highest price appreciation potential over the next 5 to 10 years. Let's get into it. There is a concept I want you to understand called the hostility discount. The hostility discount is what happens to asset values when the government of a city actively demonizes the exact people who support that city's economy. It's not a theory, it's a measurable economic force. And right now, New York City is running the most aggressive hostility discount experiment in American history. Let me walk you through exactly what is happening. In April 2026, Governor Kathy Hochul and Mayor Zohran Mamdani jointly announced a pied-a-terre tax, the first of its kind in New York State's history. Here's what it does. If you own a secondary home in New York City, meaning it's not your primary residence, and the home is valued at $5 million or more, you will now pay an annual surcharge on top of your existing property taxes. The city expects this to affect roughly 10,000 properties and generate around $500 million per year. Now, on the surface, it sounds like a reasonable way to close a budget gap. But here's what the politicians are not telling you. This tax has been proposed in the New York State Assembly every single year since 2014. And every year it failed. It failed because people understood that the moment you make it structurally more expensive and more uncertain to own luxury property in New York City, you change the calculus for every single buyer at that price point. And here's the part that should terrify anyone who owns New York real estate. Politicians don't take taxes away, they only increase them. What starts as a surcharge on a $5 million properties today becomes a surcharge on $3 million properties in 5 years. That's not speculation. That's the documented history of every tax that has ever been passed in New York City. The moment you introduce that kind of permanent, open-ended uncertainty into real estate market, you change how investors price that market. You introduce what economists call a risk premium. Buyers demand a discount to compensate for the unknown future tax liability. And that risk premium directly suppresses prices. Now, you're probably thinking, okay, but this is just one tax. Is it really that big of a deal? Here's why it is. Ken Griffin is not just a billionaire. He is the CEO of one of the most profitable hedge funds in the world. When he says New York is hostile to business and doubles down on Miami, he is not making an emotional statement. He is making a capital allocation decision. And when the CEO of Citadel makes a capital allocation decision, hundreds of his partners, employees, and business associates follow. And it's not just Griffin. Apollo Global Management, one of the largest private equity firms in the world, announced it is opening a second headquarters outside of New York in either Florida or Texas, potentially housing up to 1,000 employees. Bill Ackman, the CEO of Pershing Square, publicly blasted the mayor's approach. Former Mayor Eric Adams called the video irresponsible. The list of major financial figures who have already relocated from New York to Miami reads like a who is who of American finance. Carl Icahn, Paul Singer of Elliott Management, Barry Sternlicht of Starwood Capital, Citadel, and now Apollo. Between 2020 and 2025, Florida gained over 700,000 net new residents from New York State alone. Let that number sink in. 700,000 people. And these aren't random people. The IRS data shows that New York's highest earners were most likely to leave. These are the exact people who buy $5 million, $10 million, and $20 million condos. And here's the embedded truth. When you lose the buyers, you lose the market. Here's the thing that most people miss about this situation. It's not just about the tax itself. It's about the signal the tax sends. There's a principle in behavioral economics called loss aversion. People are twice as motivated to avoid pain as they are to seek a reward. When Mayor Mamdani stands outside Ken Griffin's apartment and says, "We're taxing the rich," he's not just announcing a policy. He's sending a message to every high net worth individual in America. New York City views your success as a problem to be solved. And once you send that message, it is almost impossible to unsend it. Because now every wealthy person looking at a $10 million condo in Manhattan has to ask themselves, is this the last tax? Or is this just the first one? And the answer, based on every historical precedent, is that it's never the last one. Now let's talk about what's happening on the other side of this equation. Because while New York is creating uncertainty, Miami is creating certainty. And in real estate, certainty is worth a lot of money. Let's start with the most basic question. What does your money actually buy in each city? In Manhattan, luxury condos in the $3 million and above segment average between $2,200 and $3,500 per square foot. At the ultra-luxury level, think Billionaires Row, Central Park South, you're looking at $5,000 to $10,000 per square foot. A $5 million budget in Manhattan gets you roughly 15 to 2,000 square feet, likely in a building that was constructed decades ago, possibly a co-op that requires board approval to purchase. In Miami's Brickell neighborhood, the city's financial district, luxury condos run $1,200 to $1,500 per square foot. In Edgewater, $800 to $1,100. In Coconut Grove, $1,000 to $1,350. That same $5 million budget in Miami gets you 3,000 to 4,000 square feet in a brand new, amenity-rich tower with floor-to-ceiling glass, wraparound balconies, and resort-level services. You're getting roughly double the space per dollar in Miami compared to Manhattan. And that space comes in a building that was constructed in the last 5 years, not the last 50. But here's where it gets really interesting, and this is the number that the real estate industry does not talk about enough. If you earn $1 million a year and you establish your primary residence in Miami instead of New York City, you save approximately $122,000 per year in state and city income taxes. Zero state income tax in Florida versus a combined rate of nearly 15% in New York City. Over a 10-year hold period, that's $1.2 million in tax savings. That's more than enough to pay for the entire carrying cost of a Miami condo. You are essentially getting the property for free from a net cost perspective. And at higher income levels, the math gets even more dramatic. If you're earning $5 million a year, the tax savings approach $600,000 annually. That's the equivalent of a brand new luxury condo in Miami every single year, just from the tax differential. Now let's talk about who's actually buying in Miami, because this is the most important leading indicator for where prices are going. In early 2026, Miami officially surpassed New York City as the major US metro with the most homes listed at $1 million or more. As of December 2025, Miami had 10,591 listings priced at $1 million and above, compared to New York's 10,176. Mark Zuckerberg paid $170 million for a mansion on Indian Creek Island, the most expensive residential transaction in Miami-Dade history. Jeff Bezos is there. Ken Griffin has been assembling one of the largest private land holdings in Palm Beach history, reportedly spending over $1 billion across multiple transactions. In 2025, South Florida recorded 361 residential property sales above $10 million, the highest total since 2021. Foreign investors committed $4.4 billion to South Florida real estate in 2025, a 42% increase over the prior year. Miami ranked number 1 in the United States for international real estate investment. These are not tourists buying vacation homes. These are the wealthiest, most financially sophisticated people on earth making long-term capital allocation decisions, and they are choosing Miami. Here is something that most people don't understand about Miami's luxury market. The supply of truly prime real estate, waterfront land, bayfront lots, oceanfront positions is finite and cannot be replicated. You cannot build more Indian Creek Island. You cannot create more waterfront in Coconut Grove. You cannot manufacture more direct bay views in Brickell. And as the demand from ultra-high net worth buyers continues to flood into Miami, that constrained supply creates a structural floor under prices. The branded residences, buildings like Baccarat Residences, Aston Martin Residences, the Four Seasons Surfside, the Mandarin Oriental, the St. Regis, Faina, are not just luxury condos. They are global brands attached to real estate. And global brands carry pricing power that ordinary buildings do not. Now here's where I'm going to be brutally honest with you, because I'm not here to sell you on Miami. I'm here to give you the accurate economic picture. Miami has real risks, and if you ignore them, you will lose money. Right now, Miami's condo market has split into two completely different markets, and most people don't realize it. The top 20% of buildings, the branded residences, the signature architect towers, the newer construction with healthy reserves, are still appreciating. These buildings are up 3 to 8% year over year in 2026, and they're trading at record prices per square foot. But the bottom 50% of buildings, the older inventory, pre-2010 construction, buildings with structural assessment issues following the post-Surfside legislation, are down 6 to 11% over the past 18 months. Some buildings have hit their owners with special assessments of $50,000 to $200,000 per unit. Monthly maintenance fees in some older towers have jumped 80 to 140% since 2021. The lesson here is simple. In Miami, the building matters as much as the neighborhood. Buying the wrong building in the right neighborhood can still cost you a fortune. I would be doing you a disservice if I didn't mention climate risk. Miami is a coastal city. It faces real challenges from sea level rise, flooding, and increasingly severe hurricane seasons. Insurance costs in Florida are among the highest in the nation, and they are rising. Now, the ultra-luxury market has largely insulated itself from the risk by building higher, building newer, and building smarter. The new generation of luxury towers in Miami are engineered to standards that far exceed what was built 20 or 30 years ago. But it is a risk you need to price in, especially for single-family waterfront properties. There are also a significant number of new luxury condo units in the pipeline for Miami over the next several years. More than 4,500 branded residential units are expected to deliver between 2026 and 2030. In a market where demand is strong, the supply can be absorbed. But if demand softens for any reason, that supply could create downward pressure on prices in the mid-tier segment. Alright, you've been patient. Here is the honest, unfiltered conclusion. Over the next 5 to 10 years, Miami's top-tier luxury real estate has significantly higher price appreciation potential than New York City's luxury market. Here's why. New York is fighting a political war against its own economic base. The pied-a-terre tax is not the end of this story. It is the beginning. Mayor Mamdani ran on a platform of taxing the rich, and he has a progressive base that expects him to deliver. The pied-a-terre tax was just the first move. Income tax increases, mansion tax expansions, and additional surcharges on high-value properties are all on the table. Every new tax proposal creates more uncertainty, and more uncertainty means more buyers choosing to allocate their capital somewhere else. New York's ultra-luxury market, the $20 million and above tier, will likely remain resilient because there will always be a certain category of global buyer for whom a Central Park South address is irreplaceable. But for the $3 million to $15 million buyer, the core of the luxury market, the value proposition of New York is deteriorating in real time. Miami, by contrast, is in the early innings of becoming a global financial capital. The infrastructure is being built, the talent is arriving, the institutions are following, and the government is actively welcoming capital rather than punishing it. The appreciation story for Miami's top-tier luxury is driven by three forces that are not going away: domestic wealth migration from high-tax states, international capital seeking a dollar-denominated safe haven, and the structural scarcity of prime waterfront land. If you are an investor with a 5 to 10 year horizon, the highest conviction play is branded luxury condos in Miami's supply-constrained submarkets: Brickell, Coconut Grove, south of 5th, and the Faina district in Miami Beach. Buy new construction or recently delivered product with healthy reserves and a clean structural inspection. Avoid older buildings with pending assessments. And if you are deciding where to live, where to actually plant your flag, the math is even clearer. Miami gives you more space, more lifestyle, more sunshine, and more money in your pocket every single year. New York gives you prestige, density, and culture. Those things have real value. but they come with a government that has made it clear that it views your financial success as a resource to be extracted. Now, the question you're probably thinking right now is this just a temporary political moment? Will New York course correct? Maybe. But here's the thing about capital relocation effect. It is much easier to leave than it is to come back. Once Citadel builds out its Miami headquarters, it doesn't move back. Once Zuckerberg builds his compound on Indian Creek Island, he doesn't sell it. Once the financial ecosystem establishes itself in Miami, the network effects take over and the momentum becomes self-sustaining. New York has incredible advantages that will not disappear overnight. The cultural institutions, the density of talent, the history of global commerce, these things matter. New York will remain one of the greatest cities in the world. But the luxury real estate market in New York is facing a structural headwind that is going to take years to resolve. Miami is running in the opposite direction, and over the next 5 to 10 years, the market is going to reflect that. If you found this useful, drop a comment below and tell me, are you Team New York or Team Miami? I want to hear where you think the smart money is going. If you're looking to buy or sell in New York or Miami, there is a link in the description to this video to reach out. Subscribe, because this is exactly what this channel is about. Not just what's for sale, but how the market actually thinks. I'll see you in the next one.